All right, so in this video, I'm going to talk just a little bit about some interest rate implications and kind of tie that in as it relates to the Federal Reserve and the fact that they change interest rates and so forth. So let's kind of talk about some of the things as it relates to interest rates. And I'm going to start off by going through some of the implications associated with lower interest rates. So if the Federal Reserve lowers interest rates and lower interest rates start to filter through the economy, you would expect that to tend to start to lower the cost of capital for companies. So the borrowing cost would tend to drift down a bit. And then also, if the interest rates available for bonds and debt instruments are going down, generally speaking, investors would probably require lower rates of return on equity investments as well. So from that standpoint, generally speaking, the overall cost of capital is going to go down. The dollar would tend to weaken. Now that's sort of a generalization that requires a little bit more explanation. Assuming nothing else is changing globally. So, using the term ceteris paribus, holding all other things equal, then the dollar would tend to weaken. And the reason for that is if the interest rate is lower, it is less advantageous for investors to exchange their currency into the dollar to invest in dollar-denominated assets because the interest rate provided in the U.S. is lower. So therefore, there would be less demand for the dollar, and the dollar would tend to weaken because it looks like a worse investment, basically. Now, if the things are not all equal internationally, and if you had a situation in which the economy is perhaps weak in the United States, which is why the Federal Reserve is lowering rates, but the economy is also very weak in a lot of countries around the globe, a lot of the developed economies, then what can happen is it is possible that even though the interest rates are going down, it's possible the dollar can weaken, or sorry, can strengthen internationally if there's enough weakness internationally. And basically, it becomes sort of a comparison game. And so, even though the economy in the U.S. may not look great, if things look worse around a good portion of the world, in a lot of developed economies, things like that, sometimes the dollar could actually gain value, even though the interest rates are going down. But holding all of the things internationally equal, if the interest rates go down in the United States, you would expect the dollar to weaken. Um, and one of the things that a lower interest rate tends to do is it tends to kind of create an incentive for people to perhaps consider refinancing a mortgage. If they can refinance into a lower rate, they have a little bit more money available in their monthly budget, then maybe they spend. That helps to stimulate the economy. Or perhaps they are more interested in buying a house. People tend to focus on interest rates a lot when buying houses. I can't resist pointing out as a little side note, the interest rate does matter a lot when buying a house, but so does the price of the house. So don't get so focused on the interest rate and how low of an interest rate is that you kind of miss the fact you're paying way too much for the house because perhaps you're in a housing bubble or housing prices have skyrocketed and you're overpaying. So something to think about. It's not just the interest rate, it's also the price you're paying that will matter as well. Generally speaking, when lower interest rates go down, kind of credit rates generally go down, and money market rates, basically anything with an interest rate is going to tend to go down. This tends to lower the probability of bankruptcy because of the fact that with the interest rates going down, companies are able to finance at lower rates. It's easier for them to make their interest payments, and therefore they're less stretched financially to make those interest payments. So it tends to make it a little bit easier for companies to survive that. And also, it tends to stimulate spending, which tends to help companies do better. Also, from a technical finance kind of perspective, when rates are lowered by the Federal Reserve, basically the fancy way of saying this is that results in a transfer of utility from savers to borrowers. And basically, what that means is we've tilted things in favor of somebody who wants to borrow and away from somebody who's saving. And so here's what that means. If you have a whole bunch of money sitting in a bank account or money markets, things like that, earning interest, maybe you're trying to live off the interest, you're a retiree. If interest rates go down, you now get less income. So basically, you're actually potentially worse off if you're in that situation. But if you are a borrower or seeking to borrow, and now you're able to borrow at a lower rate, you are now actually better off. So lowering the rates actually tends to transfer benefits, or the fancy term for that is utility, to the from the savers to the borrowers. Now, if you think about all these things that kind of tend to happen with lower interest rates, the reverse is basically true for raising interest rates. So it would tend to increase the cost of capital. It would tend to make the dollar stronger, holding everything else around the world equal and constant. It starts to look worse to refinance a mortgage. Credit rates start going up, money market rates start going up. Probability of bankruptcy starts to rise, right? Basically because it's harder for companies to make their payments. And basically, in that case, we've actually switched this, and now we're transferring utility from borrowers to savers. So savers benefit more because they get more interest on their savings. Borrowers, they're worse off because when they try to borrow, they're forced to pay higher interest rates in that case. Now, if I return back to that lower interest rate kind of scenario, if the Federal Reserve lowers rates, typically through that Fed funds rate, if they're lowering rates, if society is heavily in debt, the lower rates might not increase borrowing a lot. In other words, if you're in debt up to your eyeballs and the interest rate goes down, then you're not necessarily going to run out there and borrow and spend a bunch because you've already borrowed so much you can barely make the payments of the stuff you've got. So from that perspective, if society is heavily in debt, then people may not necessarily go out there and borrow and spend, and it may not be as much of a stimulus as you might hope. Basically, because people have little capacity left. Now, there is an interesting little note here that I should mention as it relates to interest rates. Is it possible for negative interest rates to exist? That's actually been something that academics kind of theorized and economists kind of looked at. And basically, the idea here is if you went all the way to have not just low interest rates, but like a negative interest rate, that'd be kind of like actually invoking a charge for keeping your money in the bank. So not only do you not get interest for having your money in, say, a savings account or money market account, but if they actually charged you money for having the money there. And basically, what would happen in that case is it would create an incentive for people to just take their money out of the financial institution and go spend it somewhere, right? So there is a possibility that that might actually be doable, so it might actually exist. But the implication of that would be basically you would actually be disincentivizing saving. You'd actually be telling people, like, we're literally going to penalize you for saving. And that obviously potentially has some possibly negative long-term repercussions in the sense that generally it's good if people do a certain level of savings in the long run. It helps them not become destitute and so forth. So in the long run, there's some benefits to saving. The economy needs some saving because saving can then fund investment and so forth. Investment can help with growth. So we need some saving. So if you went so far as negative interest rates, you would actually essentially be penalizing for saving. So in the short run, maybe that produces the policy effect desired of making people spend. But there is an open question, I think, about what that would look like in the long run, about how you kind of just told people to not save. And that's maybe not what we really want long run. So from that perspective, that could get kind of interesting. But that has occasionally popped up as a topic of discussion when economic circumstances have been kind of poor and low interest rates don't seem to be having as much of an effect as policymakers might desire. All right, hopefully this video has been helpful. Thank you so much for watching and have a great day.